The most profitable financial stock ever returned 12 million%. A dollar invested in S&P Global when it first started trading would be worth over $128,000 today. Sure, everyone has heard about S&P 500, but few know much about its maker. Want to know how that much value is created? Looking for a good financial services stock? Today we'll talk about why we invested in SPGI and what's so great about the company. But first, a story. If you study for an MBA at the top 10 schools in the nation, employers will find you. If you don't, you need to find the employers. And I did just that. Every weekend I was in London's financial district networking. That led to an interview at Morgan Stanley's indexing division, now known as MSCI, and I was asked if I had any questions after the interview. I fell back on the old, "What's your favorite thing about working here?" question, and the interviewer said this. He said, "We have our fingers in everyone's pockets. Because of that, we can just add products and easily sell them through our channels." And he was right. So since their IPO, MSCI has returned 2,178% versus a NASDAQ return of 243% over the same time frame. Now, it's a common misconception that MSCI manages money. They don't manage any money at all. They sell financial products, data, and services, and it's a highly lucrative business, similar to what S&P Global does. So they were one of our main competitors. And here you can see a revenue snapshot of the company. So $12.5 billion of revenue in 2023, 40% of that coming from outside the United States, 80% being recurring. Now, they define that rather loosely, as you can see by the definitions here, but it's a very stable and consistent business. Now, when we look at what they actually do, it's useful to examine operating results by division. So on the left, you can see the breakdown of revenues by division, market intelligence, ratings, indices, etc. And on the right, you can see operating profit. So since this is a more mature company, you'd want to focus on that to see what sort of exposure you're getting. Now, this firm has nearly 46% operating margins, and that's a highly profitable business across all segments. We'll look at that in a second. But what ends up happening there is you attract lots of sharks who also smell opportunity in the water. So when we look at their divisional growth aspirations, this is rather interesting. So they're looking for organic revenue in the 7 to 9% range. And I think for dividend growth investors, and we're going to talk about why we invested in this firm in the first place, because of its roots in dividend growth, you see here they have adjusted earnings per share growth targets of low to mid-teens. That's very good. That can fuel future dividend increases, and so can their low payout. They're only paying out in dividend 20 to 25% of their earnings, so there's a big buffer there. Now, when you look at the center table here, this is their aspirations for each of their divisions, and I highlighted indices because this is what made MSCI so successful, is their cash cow in indices. You see they're looking for 10% organic revenue growth. That's, I'm sure, at least partially fueled by the move from active funds to passive funds, which we'll talk about. And look at that adjusted operating margin. I mean, most companies would be grateful for a gross margin of 70%. This firm has an operating margin for this particular segment nearing 70%. That's remarkable. And when you look at how they plan to get there, they talk about, growing their revenues and spending on technology, but here they talk about run rate synergies, merger revenue synergies. And it's important to notice that this is an active portfolio of businesses, similar to how a firm like VFC buys and sells subsidiaries. And that way, they have a lot of flexibility to configure their business to industry trends. And here you can see just in 2023, all the activity across their various segments. But the one I wanted to point to here was their divestiture of the engineering solutions segment. So they're sort of refining their focus. And this slide here shows you M&A activity over time. You can see they're very active in acquiring and, of course, disposing of businesses. And that's also apparent when we look at their historical revenue growth. So, for example, look at S&P Global Market Intelligence there in the upper left. You see that big jump in 2021. It's from a acquisition. The same thing below that, their commodity insight. So they can grow not only organically, but through acquisition. And whilst I think the segment names give a good indication as to what they do, S&P Global Mobility was new to me, and this slide in their investor fact sheet describes that segment of the business. Rather interesting. So it serves the full automotive value chain. You can see dealers, manufacturing, financial. So that's a nice little business they've started up. And I think that this slide, investors would want to pay attention to. This shows revenue growth for each of their 5 main segments. Remember, they're moving out of that engineering segment. And along the bottom there, that's important. So that shows their operating margins, which you'd like to see either staying steady or moving up over time. So in this deck, it's called the Investor Fact Book. It's phenomenal to read. I think it's maybe the best, one of the best pieces of investor collateral I've ever seen. You have easy access to all the important metrics that decision makers are privy to in the organization. And for example, I pulled up this slide. For each of those 5 segments, there's rich data. This is the index segment I'm particularly interested in. You see how they break that down. So not only do they have 5 segments, but each one of those has subsegments, and they show growth across each. On the right there, they're showing revenue by type. So whether or not it's subscription, we always find subscription revenues to be more attractive. So when you look at their indexing business, I think their flagship product would be, of course, the S&P 500. It's the world's most tracked index by assets under management, or AUM. Look at $16 trillion in assets benchmarked to the S&P 500. And of course, they take basis points off that, fees, if you will. And a total of $22 trillion in assets is indexed or benchmarked to all S&P Dow Jones indices. Now, I think this slide is rather poignant when you consider the active to passive switch that we talked about recently that's affecting firms like T. Rowe Price and Franklin Templeton. So holding SPGI is certainly a good hedge against that, as investors realize that they're paying too much for active managers who can't outperform the market. 95% can't. Why would you be paying them more fees? So there's a lot of progress that S&P has made and plans to continue making based on this active to passive switch. But I also wanted to point to some technology slides in that deck, which talked about how they're using AI. And of course, firms sometimes just pay lip service, so you sort of want to dig into that a bit. They talk about natural language querying of data sets. Okay, that isn't anything that new. An in-house generative AI tool they're using. They say here, a partnership with Accenture to provide Gen AI training to all S&P Global employees. Can you imagine what that sort of brown bag luncheon would be like? We've always looked with a bit of suspicion upon Accenture's claim of the billions of dollars of money that they're making courtesy of AI. But this particular point stood out. S&P AI benchmarks by Kensho. These aren't anything new. We covered this technology, over 7 years ago, and looked at their various indices, thematic. You can see here autonomous vehicles, 3D printing, genetic engineering, drones, etc. And what Kensho does, they use natural language processing to query millions of documents like SEC filings, and they extrapolate useful information which can be queried using natural language, and then they assemble indices based on that. So we're getting a little away from the topic of SPGI as an investment. And just as a fair disclosure, this is the first time I've looked at their business closely. And one would ask, well, how could we invest in a company without doing the proverbial due diligence? Well, our dividend growth strategy, Quantigens, sorts that out for us. And here you can see the newly deployed Q-score calculator. So if you're a premium annual subscriber here at Nanalyze, you now have access to this tool. And there's over 180 dividend growth champions, international small caps, and of course our core. And also we have, I think, 20 upcoming champions. But here we filtered on financials, core, and I've just taken the top 3 names. You see S&P Global there with a Q-score of 18. And you can read the different factors used to produce that score. The data is readily available. You can also switch to Q-score data. But our DGI strategy, our portfolio, looks to spread our exposure across industries, not just using Q-scores, but also trying to have some industry diversification. So SPGI's strong Q-score makes it a very compelling financials play, and we're personally willing to sacrifice low yield for strong dividend growth. Not everybody may be willing to. And when we look at some slides in that deck that talk about free cash flow, remember, free cash flow is ultimately where dividend payments come from. You can see that nice, steady growth. Look at dividend payments there on the right, highlighted in yellow. You see Their dividend is growing by quite a bit, but still it's a fraction of their free cash flows. And also on the chart on the right, you see share repurchases. And this series of charts here really looks at this more broadly. You see chart in the upper left, cash return to shareholders, whether by repurchases or by paying a dividend. You see they're returning a fair amount to shareholders. You see the dividend growth there in the upper right, and their dividend payout there in the lower right, their payout ratio over time. So when we look at SPGI's dividend growth recently, we look at the 3-year, 5-year, and 10-year growth rate above 12% is rather remarkable. You may say, well, I don't like their current yield, which is under 1%. Fair enough. But if you give that 10 or 20 years, it starts to become very significant. That's what they refer to as yield on cost. Now, when looking at their business, I think it's worth noting the debt that they hold. And here you can see in the upper left, they've increased debt a fair amount from 2021 to 2022, likely due to acquisitions. And you see their net debt reflected here. So that's combining debt and cash, and that's the amount of debt that they have. And this is a $150 billion company. So $10 billion in debt isn't that significant. But investors will want to pay attention to ratings. And here you can see their debt ratings from Fitch and Moody's. Of course, you have them rating themselves, which they don't put that because, of course, there's a bit of conflict of interest there. But you can see the grades there. They're rated upper medium grade at the moment. So pay attention to that. We've always found that ratings agencies are a good canary in the coal mine when it comes to firms running into problems. Now, one other thing about SPGI that they point to in their deck, and it's rather nice that they do this. Look, they have their price to earnings ratio relative to the S&P 500 over time. So I've highlighted those extreme values where they have a PE twice of the S&P 500, so they would be, richly valued. Of course, quality companies are always richly valued. That's why we don't pay too much attention to valuations when we're dollar cost averaging into quality companies. But you can see here that shares would be considered rather rich compared to their historical valuations. One would, of course, wonder why that is. It's not necessarily obvious and takes more digging. But the other couple points I wanted to make here, first of all, past performance is no indicator of future results. So this is the 9th best performing stock ever. And we did a piece on the best performing stocks ever. Perhaps the most interesting bit of info coming out of that is that half of all stocks ever have lost investors' money over time. That's notable, right? That points to our own risk management approach we take when investing. But most companies don't provide investor collateral that's decent. In this case, SPGI is one of the most comprehensive investor fact sheets I've ever seen. Now, we know there's lots of money to be made in financial services, and we like to invest in leaders, and they're certainly a leader. They're extremely diversified revenue streams across those 5 segments and then further into sub-segments for each. That leads to consistency over time. It's sort of a internal diversification of sorts. It seems rather richly valued right now, and that yield provides very little income for dividend growth investors. A 1.24% max yield over the past 5 years means that's probably not going to change. You're just going to have to live with that. So the impetus for this piece is our need to find a replacement for Franklin Templeton in our new money report. I think that following what we've looked at today, we may consider looking outside financial services to get a little bit of a better yield there. Not everybody's happy about such a low yield or willing to wait several decades for that to become meaningful. And when we make decisions concerning stocks we invest in or stocks we openly state we find compelling, we move slowly and methodically with all our decisions, and they're thoroughly documented, which leads me to a video that you ought to watch we did recently on the future of asset management. It's very telling. It points to the move from actively managed funds to passive funds and what that means for the industry. Thanks so much for taking the time to watch this video today.